The book, Stock Market Cash Flow, by Andy Tanner, is the first book in the Rich Dad Advisor series to focus on the paper assets class. This book is written to help folks who are beginners or people who see themselves as students with room to grow. The topic of stock market investing is so large and ever-changing, no one can know everything about it. Wall Street experts love to tell us what they think is best for our money, but never seem to want to teach us anything. The less you understand about the stock market, the more dependent on them you feel. Choose the path of education and all of its rewards. Be sure to watch this video to the end to learn how Warren Buffett generates huge profits with options and how you can use the exact same strategy. Please subscribe to our channel and like this video if you find it useful. Don't forget to turn on the notification bell in order to stay tuned. Some of the things one can love about the stock markets are: stocks offer investors good liquidity. Stocks are agile. There are profit strategies for movement in any direction of the market, up, down, or sideways. Stocks are scalable. One of the dangers of the stock market is its accessibility. You can play the market and not realize you don't know what you are doing. Don't confuse awareness with proficiency. Become a great student, have a mentor. As a student of the stock market, you will find that everything you'll ever learn about making money with stocks will fit into one of the 4 pillars of investing. Pillar 1. Fundamental analysis. The fundamental analysis helps you identify the financial strength of an entity without ever setting foot there. The whole story is in the numbers. Start by analyzing monetary policies around the globe: deficit spending, printing money, lowering interest rates, central banks buying bonds and other securities. Studying sovereign fundamentals in Europe, Asia, and the US helps investors get a feel for the future and position themselves more intelligently. One of the most important numbers in sovereign fundamental analysis is the debt/GDP ratio. Then process with corporate fundamental analysis. It helps you with valuation. Examine the financial statement and the income statement. Use the numbers to see the value of the entity, diagnose its problems, and better forecast the future. The most important indicators are the net worth, equals assets minus liabilities, and the cash flow, equals income minus expenses. By itself, the price of a stock doesn't really mean much. You need to examine the price ratios and understand what you're paying for. The most important numbers are the P/E ratio and the PEG ratio. P/E, how much you're paying for earnings. PEG, how much you're paying for earnings and growth. The trailing P/E ratio measures the earnings over the last 12 months, where the forward P/E ratio projects what the fiscal year ahead might look like. Now that you have the ability to intelligently recognize a solid asset, there's only one constraint when it comes to getting rich. Do you have the resources to seize an opportunity? What's your buying power number? In other words, how large of an asset could you buy today? Do a fundamental analysis on your personal statement. Be specific about your buying power and seek to grow that number in cash, credit, relationships, or other forms of funding. What is your policy when it comes to buying power? Are you cutting expenses and living small? Or are you raising expenses and spending more on assets that bring passive income? Pillar 2. Technical analysis. While fundamental analysis tells us the strength of an entity, technical analysis tells us the strength of the market. The stock market goes up based on supply and demand. At its core, you are going to be studying about people's feelings, hopes, and fears. Stock charts tell the story of supply and demand, which may or may not correlate with fundamental analysis. Charts tell the story of the investors. How much are they willing to pay at the moment? Prices can move for a variety of reasons: news, a rumor, profit-taking, short covering, or for no obvious reason at all. The author reminds us that charts are not a crystal ball. They simply indicate what is likely to happen based on the historical records of past investor behavior. The book gets you familiar with the basic vocabulary used in chart reading and contains analyses of the most common chart patterns. Pillar 3, cash flow. The first two pillars are about gathering information. The third and fourth are about positioning yourself in the market in order to make a profit. There's always opportunity. It is all about how you position yourself. When you receive bad news, you have two choices. You can cry about it and hope it changes. You can position yourself to avoid the problems and possibly even profit from them. If you think something is going up in value, you can enter a long position by purchasing the item and then exit that long position by selling the item. The beauty of the stock market is that you can also profit when you think that the item is going down in value. You enter a short position by borrowing a share of stock and selling it in order to buy it back later at a lower price. Return the share to the brokerage and pocket the difference. Short positions have their risks. The stock has no limit on the upside, so potential losses are unlimited. It could be devastating if you don't exit on time. The long-term strategy of buying and holding stocks or mutual funds is about hoping for growth. This may help your net worth in the long run if the market accommodates you. But this book is about showing you how you can gain a steady cash flow from the stock market so you can cover your bills. Determine your monthly expense number. Most people use a job to generate the income they need to meet that expense. Challenge that way of thinking. That's what the wealthy do. Your monthly expense number is your investing goal. Develop a plan to go out and buy some stock to make $10, then $100, and then keep building your assets to provide you with the needed income to cover your expense number. Don't forget that not all cash is equal. In the US, earned income can be taxed up to 39%, but capital gains can only be taxed up to 15 to 20%. With the right tax planning and the right positioning, you can make almost any income passive income and receive the maximum tax benefit. To learn more about this, check Rich Dad Advisor Tom Wheelwright's book, Tax-Free Wealth. Every investor is looking for a high return on his money. There are two ways to increase the rate of return. The first is to have a bigger gain. It's impractical to rely on this approach since you are somewhat at the mercy of the market. The second is to reduce the initial investment amount. If you can find a way to reduce the initial investment as close to zero as possible, the rate of return can grow very large. The way to do this in the stock market is to use leverage through buying or selling stock options. Note that with options, you gain leverage without debt. It's useful to remind ourselves just how powerful the concept of leverage is. Using it intelligently can make life a lot easier for you. Archimedes famously said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." Suppose you are looking to buy a particular stock at $50 per share. The most common path would be to purchase shares of the stock. If you buy 100 shares, you risk losing up to $5,000 if the stock does poorly or the company goes bankrupt. Another possibility is to buy a call option for that stock. You start by making a few decisions. At what price do you want the choice to buy shares? Strike price. How long do you want the option to last? Expiration date. How much will the contract cost? Option premium. In the US markets, a single option contract gives you control over 100 shares. If the premium is $3 per share, you only have to risk $300 instead of $5,000. If the stock goes down, you are not obligated to buy it. If the price goes up to $100, you can sell the actual agreement itself. If you can sell it for $5,000, you paid $300. Your profit is $4,700, and your initial investment was only $300. You can see that with the stock option, you are leveraging a small amount of money without using any debt. The tricky part is that option contracts expire, and as time gets closer to the expiration date, their value shrinks. Therefore, options have both time value and intrinsic value. The author goes in depth explaining the details you need to know about trading options and advises to use option contracts to accomplish any of the three investing goals: capital gain, cash flow or hedge, or any combination of the three. The strategy Mr. Tanner recommends is generating cash flow by selling covered options. This is especially useful in difficult markets where buy and hold investors are suffering from crazy up and down conditions. As a quick reminder, an option is a promise by someone to sell a certain stock at an agreed upon price until a certain date. In return, he receives a premium as income. This premium is not just based on the movement of the stock price, but on the movement of time. Time decay works to benefit the option seller. Let's see how selling covered call options works in practice. First step is to buy 500 shares of XYZ stock at, let's say, at $140 per share and hold it for a year. Then you sell 5 one-month call option contracts on XYZ at a premium of $2.50. You have promised the buyer he can buy XYZ for $154 at any time before the expiration date. The stock could now go in one of the 3 directions. 1. XYZ goes up and the buyer wants to buy at $154. You will make money by selling the stock since you bought at $140. 2. XYZ goes sideways and the option expires worthless. You keep the premium, $2.50 multiplied by 500. 3. XYZ goes down and the option expires worthless. You again keep the premium of $1,075 as your cash flow. The stock is falling in value, yet you continue to sell options on your shares month after month the whole year, and you have generated a nice income. The famous investor Warren Buffett has used the same method for years to generate additional income on his holding company. He sells a lot of put options, which means he is making a promise to buy a stock at a certain price before expiration. Let's pretend that Warren Buffett wants to increase his holdings in Coca-Cola, KO. The stock is trading at $39 per share. Buffett conducts a fundamental analysis and decides he is willing to buy at $35. He sells 5 million put options with a $35 strike price for a premium of $5.50. That would be an income of $7.5 million. If Coke shares fall below $35, the option buyer would then sell their shares to Buffett, and he would buy at the price he wanted anyway. If the price of Coke climbs instead, Buffett would still be happy to collect the premium, $7.5 million. The same will be true if the stock holds steady at $39. Educated investors position themselves in such a way that they can be happy regardless of what direction the market goes. Pillar 4. Risk management. Basic risk management is the 4th, final, and most important of the 4 pillars. For any type of investor, keeping a tight leash on risk is perhaps the most important skill you can have. When investing, you're dealing with all types of risk: systemic, non-systemic, purchase risk, interest rate risk, political, legislative risk, and etc. As an individual, you certainly cannot control these factors, but you can control your exposure to risk, implementing massive, intense, unbreakable rules. Here is your risk management toolbox. Solid fundamental and technical analysis skills. Proper risk-reward ratios. By setting a target, you can calculate the reward you are aiming for and decide how much risk you are prepared to take to get the reward. Stop-loss orders and exits. Your exit order will be triggered if the trade turns against you, limiting your loss. Protective put and call options. Insure against loss, just as you insure your house against fire. Non-correlating assets. If one of your trades tank, all the others won't necessarily tank with it. Position sizing. What percentage of your account are you prepared to risk in a single trade? Now that you have become familiar with the 4 pillars of investing, your next steps will be to review your lifestyle goals, your money goals, and your education goals. Develop the habit of doing fundamental analysis. Practice paper trading in a virtual account. Begin building your investment team. Never stop learning. As a final thought, let us offer you a vital truth. There are no true money problems, only education deficits. The lack of money is always secondary. It's never the primary problem. If you enjoyed this video, you are sure to like another one of our summaries on a Rich Dad Advisor book, Tax-Free Wealth. Thank you for watching. Please check out our channel for more videos like this.
Tell us in the comments, what is your favorite book? Can't get enough of reading? Find us on Facebook at facebook.com/readandgrow1 and also on Twitter at twitter.com/readandgrow1.